The state of Oklahoma is looking at a big tax break for oil and natural gas producers and openly questioning whether a change is needed, a change likely to be strongly opposed by those in the industry. This comes as a noted Oklahoma economist sees problems in a tax structure that gives billions of dollars in tax incentives to stimulate business.
Tax rebates, refunds, and credits for the state's oil and natural gas industry have been around for decades, seen by lawmakers as a way to encourage drilling, but they have hit the state's bottom line hard in just the last 12 months, costing $321 million. State Finance Director Preston Dorflinger says it's time to have a sit-down and change the tax deal, not just because of the impact on state government, but also because the tax breaks are set to expire over the next 2 years.
And that's why I think it's important that the energy industry engage with us in coming up with a solution, because I think it would be their preference to not see it go back to 7. But there is a provision in place where these sunset.
Mike Terry, president of the Oklahoma Independent Petroleum Association, says the tax structure in place now may be costing the state, but it's a structure Oklahoma wanted, and his membership wants it to stay put. He sees any talk of changes as an attack on the industry.
It's an attack in the way that you're talking about the possibility of increasing taxes. And that is not the way you stimulate the economy.
Finance Director Dorflinger sees it differently.
I think attack is an overstatement, and I understand OIPA's position, but at the same time, everyone knows that something has to give on this issue.
But for David Blatt, president of the Oklahoma Policy Institute, the loss over the last 12 months is nothing compared to what those tax breaks have cost state government over the last 4 years.
At the 4-year period, because you have 2010, 11, 12, and 13, we'd be nearing $1 billion.
The best estimates put the loss since tax breaks for horizontal drilling were put in effect in 2009 at close to $800 million. Tax breaks, Blatt says, are simply no longer necessary.
We think that the evidence is overwhelming that these tax breaks have become unnecessary as well as unaffordable.
There are an estimated 250,000 active oil and gas wells in Oklahoma. Most of them have been producing for years and were drilled with old technology. This year, however, more than 170 new wells have been drilled, and over 160 of them are horizontal wells. Stacy Schusterman is chairman and CEO of Samson Energy Company, LLC. She says horizontal drilling is now the industry norm, and in an email to ONR, she says, quote, "Industries will always say they need to keep the benefits they have been given, but horizontal drilling is well perfected now, and companies, both in Oklahoma and from out of state, will continue to want to drill in Oklahoma, even if we go back to 7% severance tax, because the geology and reserves of Oklahoma are high quality," end quote. Oklahoma's gross production tax is 7%, except for horizontal wells, that's now 1%, a tax that lasts for 48 months after the well begins production. And since most of those wells are now producing oil, all of that 1% tax goes to county government for roads and bridges, and the rest for public education. The tax mix is different for natural gas. Most of that 1% tax goes to the state's general fund. But as Mike Terry explains, that too is not producing much income for state government.
Well, what's happened to natural gas prices? They've tanked. And if you look at the graph, if you look at a graph of natural gas prices and you correlate that with the general fund, the gross production tax that goes in the general fund, they run together.
All of this still adds up to state government watching a boom in the oil patch and not seeing that show up in the general fund, a situation that began 4 years ago that up until now has received little attention from state officials.
If it teaches us anything, is that there should be review from time to time. And again, regardless of anything else, that's simply all that I've tried to say, is that things have changed.
Tulsa oil woman Stacy Schusterman agrees. It is time to look again at oil and natural gas tax breaks. She says, "I believe the credit should be revisited because we need to invest in our state's infrastructure, particularly in education. Oklahoma has a college degree attainment rate of 25% versus 33% nationwide and 48% in Massachusetts. Our state needs to put more into developing our human resources, not our oil and gas resources, because investing in our human resources will have a broader benefit to Oklahoma citizens, not primarily to out-of-state shareholders. OPI's David Blatt believes that many others in the oil and natural gas industry agree with Schusterman.
You can understand how some in the energy industry says, if you're going to provide us free money, we'll take it. Thank you very much. But do they need it? No. And many of them will acknowledge privately that they don't need these state tax breaks.
For Mickey Hepner, Dean of the University of Central Oklahoma Business College, there is more to discuss for state officials than just the gross production tax.
Because we've been giving back so much in tax revenue, whether it's with the income tax or other taxes, that we really haven't been able to adequately fund key government services that really help improve the quality of life in this place, that really make this place a more desirable place. It's really hard to imagine a robust economy with a place that is populated with uneducated, unhealthy citizens who travel down dirt roads populated with criminals.
Hepner says the figures he has been seeing for Oklahoma's overall economy should be setting off alarm bells at the state capitol, that it's time to change the way they view tax income.
I've been picking up ever since October 2012 a definite flatlining or stagnation of state revenue collection, especially with state sales tax collections.
Hepner says there is weakness across the board for state government income.
But frankly, there was quite a bit of weakness in motor vehicle taxes, sales taxes, and even income taxes throughout most of the fiscal year.
Coupled with ongoing federal budget cuts, which impact much of state government, Hepner says more budget cuts for state agencies are not out of the question.
I'm still showing us coming in at a little bit less than what was officially estimated for next year, not quite below the threshold that would require mid-year cuts, but it's certainly a possibility if the revenue picture continues to weaken and weakens at an increasing rate, then state agencies could very well be facing a set of mid-year budget cuts.
And income for state government may soon take another hit, depending on what happens with the constitutional challenge to a law that cuts the top income tax rate over the next 2 years.